Hey everyone, back again for another edition of That's Our Two Satoshis Live, where we're talking everything crypto markets. I'm Jeff Dorman, CIO and co-founder of Arca, and joined today by Chris Sullivan, who is the co-founder and PM of Hyperion Decimus, which runs multiple different fund strategies. And I've known Chris now for probably almost since we both started in crypto many moons ago. So nice to have you join me, sir, and looking forward to talking about the markets with you.
Yeah, honored to speak with you, buddy.
Good. Before we get started, as always, this is not intended to be investment advice, but we are going to talk about what happened in the market for those who like to read. You know that we also write a blog at Arca on our website, ar.ca/blog. And then we come and talk about it on Tuesdays, what's going on in the market. So, Chris, I know you and I look at the market a little differently. You know, I've obviously had a kind of equity debt value and distressed upbringing, focusing on fundamentals. You've obviously always been more on the technical side and charting. You know, I was looking at the sell-off from a week and a half ago. I was looking at the sell-off from okay, that was ridiculous. That was clearly just an insane reaction to basically two pieces of information, right? You basically had the Japanese yen carry trade and maybe recession fears. Maybe you could throw a third one in there with jump, selling some ETH. But overall, essentially just a complete fear trade that got out of control. I was buying, you were buying, and lots of people were buying. And what I said I was looking for confirmation was, are we going to see any sort of like real strong Bitcoin and ETF inflows to confirm that retail was buying the dip? Are we going to see Japanese equities recover? And will we see some sort of a statement from the Fed or the BOJ or other central banks assuring the market, reassuring the market really, but without doing something stupid like a panic cut? I got all three of those. I felt pretty good about where we were buying. I still feel good about it, given the reactions we've seen. What were you looking at, given that you look at the world slightly differently?
Yeah, I mean, bottom up, we agree on, like, for the fundamentals matter, and I think the quantitative or TA prism is just a confirmation or a contrarian type of piece against fundamental and macro backdrops. So when conditions like this align, you have to be a buyer, because give or take the last 6-7 years, there's been about 5 of these kind of events, right? Where you get a flush, and then, when we get fear flipping at a top, right? This kind of ferocity, that can mean recession, that can mean all kinds of things from a macro level. But when you're doing it from kind of this middle, it's already been correcting since March. This is typically, and we discussed this earlier, an Elliott wave term, C for crash, is a final liquidity flush that kind of culminates the correction that in crypto began in March, right? Which has been a long and very healthy one. You've got below stock to flow. You've got 5-year lows today in GUI, in gas fees for Ethereum, and then a washout across all the names. The equity market's perhaps a little more noise than signal, because it's very, very liquid here. Hence the Japanese equities down 20, up 20, But I think the macro backdrop keeps increasing. M2 just broke out further globally. So you got to look at the weight of the evidence and appraise, hey, this is an opportunity.
Yeah. So when you look at that across the equities as well, like I saw a stat today, which I thought was interesting, that every single time the VIX rises above 50, 91 out of 92 times that's happened, the S&P was higher a year later.
Mm-hmm.
And again, when you see obviously, if you go back a week ago Monday, in the moment it was scary. The Nikkei was down 12%. The Nasdaq futures were down 6.5%. Credit spreads were starting to blow out. You had treasuries, a real flight to quality trade. Most people saw through it, recognizing that there really wasn't any fundamental error here. It was just sort of a structural unwind trade. But when you look at what to buy historically, when I look across asset classes, I'm like, oh, well, if this is a structural sell-off, I want to buy crypto with the highest beta. And in fact, that hasn't been the best trade. You've seen a much bigger bounce back in both Japanese and U.S. equities, a much bigger bounce back in credit spreads. Obviously, the VIX, going from where it was 65 down to, where is it right now, 18.
Yeah.
It's strange that the crypto bounce back was so muted. What is that telling you when you're looking across any of these signals that you're looking at?
I think you look at the buy side, which has been really whales with conviction, right? And those numbers are on a 30-day lag are at all-time highs, right? And then you look at sort of who panicked out, U.S. makers primarily. We don't have to name them, And then where are they going to go to if they have liquidity? If they're out of crypto, it's going to be equity. So I think it's again a sum of all the evidence. And it's select equities too, right? It's kind of the liquid mega cap darlings that had the most ferocious bounce back, right? That represent, I think it's 78, 80% of the index overall, whether it's the NASDAQ or the S&P at this point. So I think we'd like to have seen a more heavy beta, high octane rally, just because that's prototypical of crypto after big sell-offs. But you really had quite a bit of destruction, 1.2 to 2 bill of total leverage taken out on perps, depending on the name or in aggregate. And then, who's the marginal buyer at size here, right?
Yeah, and I think you mentioned the washout on futures. Typically when you see those kind of reactions, when you see the leverage get wiped, when you see fear and greed indexes go down to the 10s or 20s, those are almost always good buying opportunities. And even though we haven't seen a ferocious rally back, I mean, for the most part, Bitcoin and Solana have rallied all the way back. Even Telegram, some of the more favored tokens in the market, it's really ETH and more of the mid caps that have just been stuck and just refused to kind of go back up, which begs the question: was jump selling $500 million of ETH enough of a trigger to really knock ETH down 15% relative to the other tokens? Or was it just ETH was already weak, it's been weak for years, and that was just sort of the straw that kind of broke the camel's back? And how do you look at, given that there's a lot of kind of short-term disruptions from a supply standpoint this year, things that intuitively seem short-term in nature, whether it's Mt. Gox selling or jump selling or German government selling, versus what it does to maybe some of the charts or some of the signals you're looking at? How do you kind of weigh common sense versus what it means to your systematic trading?
Yeah, I mean that's a really good question. I will provide precise mechanical answers. So unlike equities, which have immense opacity, right? Like one of the reasons it bounced back so massively is what just happened this week, right? The buyback window opened back up. Everybody and their brother knows that. So what are they going to do? Pile in at lows and sell into that buyback, right? That's like, this is so transparent. What happens when wallet addresses move off exchange, on exchange, bids in the order book, right? You've got bids and asks, right? The makers have gotten wise over the last 5 years. Bids drop to absorb the sell side pressure because a lot of these entities that are executing, it's extraordinarily sloppy. Like it's not like they handed you that N number of billions to sell. You're not market ordering it to an OCC desk or exchange, are you, Jeff? You're going to methodically VWAP and TWAP and do it smoothly to have no adverse selection and very little price impact. So I think that in my view of appraising all of those factors, the amount of pressure, sell pressure this space has absorbed is pretty immense.
Yeah. And it's interesting too, because I think this is the double-edged sword of the transparency of crypto.
Right.
During the same week, for example, we hear that Buffett has sold, all of his Apple stock or half of his Apple stock. Yeah. Only he probably did that in March or April. We just found out about it in, 1st of August. So there is something to be said about being able to do this quietly and then having to report later in a 3-month stale, 13F or 8K of some sort, letting you know what you did, versus everyone knowing immediately what's happening as a wallet moves and panicking and freaking out, dropping all the bids to absorb what should be, a non-event, right? $500 million of ETH, for example.
It's nothing.
It's nothing. Yeah. It's absolutely nothing. I mean, we had 150 million of inflows like the next day in the ETFs alone. But because so many people saw that and so many market makers panicked and so many levered traders started piling on, it does create a little bit of that increased volatility. Again, short-term in nature from an intuitive standpoint, but potentially long-term in nature in terms of damaging charts or damaging sentiment and psyche.
Well, I think in addition to all of those points, unlike when you and I started 16, 17, 18, right, where there was very crypto native makers, you've got makers that are across equity, index products, options, et cetera, they're agnostic to their commitments of capital. They don't really know the mechanics of crypto as well as the sadly a lot of the makers that got put out of business over the last 3 bear markets that have occurred in 6 years. And so the impacts are just more exacerbated than they otherwise have been. But I also think like they, because of that, ETFs can only trade a few hours a day, certainly not on the weekends. So in a picture where they can trade 24/7, we may have had totally different reactions, right? Maybe not as big of a knife down, or perhaps a larger one with everybody panicking. So I just think everybody has to look at all of the different compartments of data and evidence to go and appraise the situation.
Yeah, so let's talk about that for a second, because I've been on record multiple times for almost probably decades now talking about how correlations have less to do with the assets themselves and have more to do with the people who are actually trading those assets. A recent example we talked about with Bill Wang and Archegos Capital, how all the stocks he owned had nothing to do with each other, but when he was the only one buying and selling them, they were incredibly highly correlated. So you mentioned that a lot of the market makers are not, all the traditional crypto or all the crypto native market makers have basically blew themselves up in 22, from Alameda to others who have now unwound and gotten out of the market. Mm-hmm. And they've been, basically not replaced, but now superseded by more of these TradFi market makers who are doing multiple asset classes. With that in mind, you'd expect the correlation to be even more positive now between crypto and equities. In fact, you're seeing the opposite, right? Over the last 6 months, the NASDAQ and Bitcoin have never been more negatively correlated, negative 0.8 correlation between the NASDAQ and Bitcoin. Obviously, that correlation picked up a little bit in the last week and a half because of the mini crisis, if you call it.
Yeah, Liquidity One event. Yeah.
But again, in general, if you have market makers across all these different asset classes, again, I would have expected crypto to be 2-3x beta to the upside this week, and it hasn't done that. Like, where's the disconnect there?
I think you had most of that liquidity engine absorbing the ferocity of the selling, and then we just need to see a couple down up sequences and then a follow through and breakout. We're really at the highs today. We got close to what I call this confluence cluster of resistance, which is right around the 100-day MA. There's the MA clusters right around 64K. That's also a pivot. I think tests there fade a little bit. Once it busts through that, the 71-ish resistance, which it's hit in this big flat that we've been in since March, that's just going to provide, it's going to knife through that. But I think to your point, price is an expression of only two things ever in every asset: psychology and liquidity. So I think in this instance, just in a 2-week prism, psychology did matter a lot.
Yeah.
Right? Everybody's so, you could blame it on COVID or propaganda or whatever. Everybody's so hypersensitive. They're flipping from max bull to max bear. And then people like us get to take advantage of that for our client base. And then certainly I did personally. Like, right. Oh, you're giving me a 20 delta move in 4 hours? Thank you very much. And then look at the price that it just did that. Fear hit 12, maybe intra period 10, and we're buying at 50K. That's not scary. I feel like I'm still overpaying,
Yeah, that's a fair point. With that, sticking to that for a second, in terms of correlations and sort of the reactions here, every single time we see any sort of a market dislocation, immediately the Bitcoin naysayers say, "See, I told you Bitcoin's not a flight to quality asset," which is a ridiculous argument if you ask me, because there's really only one market flight to quality asset, and that's U.S. Treasuries, and you see it every time where bonds are bid when everything else is selling off. But you do see other types of safe kind of haven trades. Maybe that's investment grade bonds. Maybe that's certain types of equities relative to other equities, et cetera. It's always more nuanced than it's just did this protect your portfolio. What I always think about Bitcoin is it was never designed to be a portfolio protector in terms of like market sell-offs or crises. In fact, the only time I've seen historically that Bitcoin reacts is anytime there's a lack of faith or fear in governments and banks. That's when you tend to see a bid for Bitcoin, right? It happened with Cyprus banks. It happened with, when the Turkish lira was debasing. It happened with the Canadian trucking convoy. It happened with the March regional banking crisis in the U.S. That is where, and again, I'm not a quantitative trader. I'm not certainly running algorithmic formulaic investment strategies here, but like, that's how I would only look at Bitcoin. Is if it's something about governments or banks, I would be bid Bitcoin. If it's a regular just market sell-off, technical, fundamental, whatever, based on other factors, I don't expect Bitcoin to ever protect a portfolio. Go ahead.
So obviously I agree with those points, but I think you just described a portfolio hedge, Jeff. I mean,
sure, but I don't know if you could blanket say that is then a flight to quality. I think you'd have to make a nuanced new category called a flight to government bank inefficiency.
Right. Well, that's not. I mean, to be fair, like I'm not buying treasuries. That's the most terrifying trade on earth.
Yeah.
Like you want to buy debt. First off, let's look at it from a quantitative perspective. They have negative convexity.
Mhm.
They are negative against inflation, both, the government number and the real number. And then I've got interest rate risk. I've got duration risk. I've got all these other risks where Bitcoin and Ethereum, anything fully diluted in the crypto space. Speaking of which, I love the fully diluted, old school DeFi names, which actually have had pretty great bounces here in the last 5 days.
Mhm.
Even the exchanges like DYDX and Uniswap. But I don't. It depends on the investor, right? Like the narrative is treasuries are a flight to quality. I agree with you completely. But then when you get under that to high yield or corporate, if you're assuming recession, why the heck are you going to buy bonds that rely on cash flows from consumerism? Like that's not logical. Whereas I've only got 21 million Bitcoin. I want all of it, right? So flight to quality, I'm not a biologist, but define that, I mean, what does that even mean? Like to me, it's, the only reason to invest is because of this monetary gain, right?
Mhm.
You have to outpace inflation to maintain purchasing power. And Bitcoin has done that better than all asset classes combined.
Yeah, and I think it's a little bit of a marketing thing as well. Is that, like, again, I always laugh when people call Bitcoin digital gold for a couple of reasons, right? One is that not that many people really care about gold in the first place. Like, why are we chasing something that only like 7 macro funds and a few 90-year-olds even care about? And two is, again, to me, it's thinking about Bitcoin in terms of like a credit default swap or like, protection against banks and governments is a much stronger, more logical narrative than talking about it as some sort of like gold inflation or market dislocation hedge. So I think the more people recognize, I think some of the Bitcoin didn't create its own narrative. Other people created the narrative for it, right? But as we're seeing over now 13 plus years of data, it really is part of the responsibility, I guess, of the Bitcoin community is to kind of reshape that narrative. And to me, that narrative is really easy. It's like, no, we're not trying to hedge your portfolio in a giant wick down based on the Japanese yen leverage flush out, but we are going to protect your portfolio against government and bank irresponsibilities, which has been happening for centuries.
Yeah, and that's the big one. Like liquidity flushes are always opportunities. Doesn't even matter the asset class,
Yep.
right? And that is a human condition, not specific to assets. Like what we just mentioned and discussed the whole time are mechanical factors and positioning factors, right? People got over leveraged to the skis because of the yen carry trades. It was in the trillions. Margin called out the wazoo, and people, big money, got blown out, and they had to sell everything. Gold went down too. I mean,
yeah, it was fun. It was fun watching the traditional finance folks freak out on Monday, even though, like, in crypto, we're like, yeah, we see this every other week. We're pretty used to these leverage watch.
Yeah, like, wait, fear hit 12. We're not even down 30 intraday. I was like, this is weak, guys. Like, why is everybody complaining? Take the win and buy.
Exactly.
I mean, how much longer are we're going to get below 6 figures to deploy fiat, which has n number of days left? This isn't a game that's going another couple centuries, Jeff, and you know that.
Yeah, I totally agree. All right, I think we're bumping up on time here, Chris. It was a pleasure having you. What can we leave with, like, after the buying spree that you did, after what you've seen, like, where are you now? What are your thoughts? Give us something to take us home.
Yeah, we want to see some constructive backfilling in technical terms, like some good up-down sequences that hold higher lows, right? I want to see flows continue to be positive. I really want to see the central banks hold off on rates until after election season, because I think it's really irresponsible to front run that. The market already priced it in for them, which has traditionally given them cover to act. So I'm not anticipating they listen to that, but I just want to put people in the position of like empowerment through knowledge and understand all of the influences in the next 90 days that could affect price, and make sure you're armed with the right information to do well for yourself.
I like it. Well, we'll see what the market gives us over the next couple of weeks. Chris, appreciate you joining. Where can people learn more about your funds? Where can they follow your thoughts?
Well, so I don't have X or anything, but we're HyperionDecimus.com. We're super private. Happy to schedule calls with anybody, respond to emails, but that's the best way to get a hold of us is on our website.
Perfect. And as always, anybody can read the blog on our website, ar.ca/blog. You can find us on X, Twitter. I'm JDorman81, and you can have us at ARCA. So that's it for this week. Chris, again, thanks for joining us, and let's hope for more constructive, better markets and lots of alpha going forward here.
All right, buddy.
Thanks again.
Thanks for having me.